Oh, okay. You know what? You have to go to the left a little bit.
Me?
Yeah, yeah. There you go. There you go. You're good. Okay.
All right. So we've been getting a lot of inquiry about these ARM loans, and I just want to explain to you guys how it works. So now that we're in a rising interest rate environment, rates are starting to go up. It's a good time to consider an adjustable rate mortgage to your customer. Okay. And a lot of people are very scared of them because of what happened in the recession, and so they've kind of gotten a bad name because of how they were structured before a long time ago. And so fortunately now the way that they're structured is more safe and sound. So you know, people are not going to necessarily lose their house, and that's kind of what was happening before. So a lot of people are very scared of them. So I would say that, you know, you need to be mindful of who you're offering this to. I would not offer this to, you know, a first-time buyer, you know, with fair credit and a small loan. I would suggest that you use this for somebody that's, I call a savvy customer, that's more well-to-do, that understands what they're getting into, and I'll explain why. So so a couple things. Why do you want? And all you guys got this email, by the way, with the explanation break. I'm just going to go over it quickly and then give you a test question that everyone needs to answer. So make sure you have your calculators with you. But basically, the reasons why you want to offer an ARM loan is because it has a lower introductory rate than a fixed rate. Okay? So in this example that we're going to talk about today, we're just going to use that today. Let's just assume that this is the start rate for a ARM loan at 4%, and a 30-year fixed is at 4.5%. Okay, so 30-year fixed is at 4.5%, and an ARM loan is at 4%. So can you just check and make sure that's recording?
It is.
Okay, so on a $300,000 loan,
It's live.
yeah, that's fine. I'm gonna start doing everything live. No.
Make it more organic.
Yeah. So 4.5%, the interest rate or the payment's $1,520 a month on a $300,000 loan. On 4%, the payment is $1,420. So it's $100 a month savings. Okay. So and this is on a 7-1 ARM. Okay. So the thinking is that, well, why would I want to pay an extra $100 a month when I can go do something else with that money? That's how smarter people think, right? I mean, that's how they think about those things. And so why would I want to give an extra 100 to the bank? I can go send my money somewhere else and do something else with it. And it's the same loan, basically, for the first 7 years. And so that's the benefit, and this is available for FHA, it's available for conventional, and it's available for portfolio loans. And as a loan officer, one of the things that Danny was talking about yesterday, coming off as the expert, when you're dealing with bigger loan amounts, people that are more financially savvy, they're going to want that as an option. Okay. Remember what Danny said yesterday in the meeting, that the reason why the guy went with him because he seemed very knowledgeable and gave him the options. Danny gave him an 80-10-10 combo loan, a 10% down loan, a no PMI 5% down program. He's whipping out all this stuff out of his toolbox because he knows all of it. Versus if someone else that's unskilled is, oh, here's a fixed rate, and that's what the other loan officers are telling him. Okay, so and that's how you're able to win in deals. So anyway, so those are the reasons why 7-1. Who knows what 7-1 means?
The rate stays the same
Fixed for 7
years and adjusts each year.
Okay, so let's say that for the first 7 years the interest rate is at 4%. Is that right?
Mm-hmm.
Okay, so, and, what?
Yeah.
Okay, so what happens in the next month after that?
It just goes up.
It adjusts based off of what the new
What the prime rate
for-
is.
The prime rate is at the time, yes.
And there's your caps.
It
Okay,
adjusts to the.
so what is this number mean right here, guys?
That's the maximum adjustment the first year.
Okay, and what's this number mean?
the-
That's
Yeah.
that's how long it lasts. So that's the first it's
It's the max
fixed for 2
adjustment.
years.
That's adjust, right? It's the max
So
adjust, it can't go-
the two new points is gonna increase for another 2 years.
Well, we're gonna explain that.
That's the
No, no,
maximum
no.
adjustment each time it adjusts is
Correct.
2%. You can only go up 2% at a time.
Up or down?
Up, yeah, up or
And
down.
what does this number mean?
That's
Or
the
the
lifetime cap.
Lifetime cap, yeah.
Okay, okay. So, so let's say that the person, I mean, so far, it's pretty good, you guys got a pretty good understanding of it, so, most mortgages are actually, tied to the, it's the LIBOR, index and not prime. So, they'll really be looking at LIBOR, as the index, and so,
Did you do the life for it?
LIBOR.
LIBOR.
Aren't there like
LIBOR.
three
LIBOR.
indexes that you primarily look at?
There's several, yeah. There's a Treasury, there's Prime, there's the Kofi, there's a lot of different, so there's a lot of different ones. So, so basically, in this example, let's say that, yeah, in the first year, this is telling you in the first year that the interest rate can go up or down 2% based on what that LIBOR index is doing. Okay, so if the rate starts at 4, so on the 85th month, they're going to check and see what is the index doing, and then adjust this interest rate accordingly. Okay, so on that 85th month, they're going to look at it and say, okay, what is that rate doing in LIBOR? Is the rate, so let's say that the LIBOR rate, for whatever reason, is at 10%. It doesn't matter, because the most that his rate can go to is 6%.
6%.
The lowest it can, let's say that the LIBOR rate is 1%. So the lowest that his rate can go to is 2%.
That's after the 7 years, right?
Yes, that's after
Okay.
7 years.
Okay.
Yeah. So his rate will be anywhere from 2% to 6% max. Okay? And the first year after the adjustment. That's a 2% max. So what this is telling you, this third or the second cap right here is telling you for the remaining of the term, it can never go up or down more than 2%. So basically, so if this was a 3, what does that mean then, guys?
That would be,
You can go to 3.
If this was a 3 instead of a 2, what would that mean?
It can never go up more than 3%.
After the first year.
Yeah. Yeah. After
So,
the first year. The first year it's 2.
So in year 9, what would be the highest rate you could have on this loan in year 9?
5.
3%?
Or wait,
Well,
sorry,
3
9% would be.
In year 9 would be the second year of the term of
6.
the loan.
7%.
Oh, you're right.
7%. What would be the lowest rate you could have?
1%.
How did you get that percentage?
Well, because so in year 9,
Uh-huh.
it's the second year of the adjustment, and you have a max up or down of 3%. So the highest it could be is this plus the 3%, which is 7. The lowest it could be is 4 minus 3, which is 1. And now I'm gonna tell you something. Real smart people, they already know this. Okay? Like if you try to put this shit on me, I'll catch you real quick if you lie to me. So if you want big loans, you better learn this. Because I remember I did a $2 million loan for a guy that was an executive at Deloitte, and he grilled me on this. But I got his loan though. So, and in Bel Air. So, they already know all this stuff, but they want to see what you know. Believe if smart people are talking to you, they already know the answer, but you should assume that. They really want to see what you know. And so,
Most of them are pretty savvy in finance. I mean,
yeah, that's how they got.
investments
That's
and-
how they got to that situation. So, so anyway, it's important to understand this because you know this is going to come up, and you know, you want bigger loan amounts, that's what we're talking about, right? You gotta know this. Does everyone get that part right there? It's pretty simple, right? It's not, okay.
I'm a little confused.
Okay, but we'll work on it.
Yeah.
So, right here, this is the, what did we say that was?
Lifetime cap.
Lifetime cap. So what's the highest the rate can be in the whole life of the loan?
9%.
Okay, and what's the lowest it can be? Well, the lowest it can be is, so basically if the start rate is at 4%, the lowest that the rate could ever be in this scenario is 1%. Okay? So, so you guys see how the inner workings of that? Now, if you saw that, would you be interested in that type of loan, or is it too?
Can they do a refi after 7 years?
We can do a refi after 6 months.
Yeah, you can do it whenever.
Depends on where the market's at.
Do you ever know what the margin is on this?
Yeah, it's disclosed on the, when you lock it. It depends, I mean, usually it's like 1.5 or 2%.
Okay, so like how could you get it down to 1% unless it was like
It depends, you can choose, so let's say that you choose a margin of 1% and there's a cost of 0.5 point to get it. Right now LIBOR is at like 3, and so let's say that the market tanks and there's a huge crash and LIBOR drops to 1, you know, so that's how they would be able to. There was a time when in 2009 when it touched down there, and we call people up and, you know, looking to refinance. They're like, I have a 1% rate right now. I want to refinance, you know, and because, you know, there was times in 2006 when my second house that I bought was on an interest-only arm, and the rate was at 7% par. You know, so I mean that was a different time. It depends on what's going on in the economy. But the thing is that now, for underwriting purposes, the question I have for you guys is, so, and you need to write this down. If a person's making $60,000 a year income and they have a loan of $200,000 and the escrow and PMI is $6,000, what is the qualifying housing ratio? So if a person's making $60,000 a year,
Okay.
the loan amount is $200,000, and the escrow and PMI, the total payment, everything is $6,000. What is the qualifying housing ratio?
Is it the same as just like a regular conventional loan?
No. What is this person's ratio? What are these people's housing ratio? Does that make sense? Oh, you have my pen. Sorry. Okay. I want to know what's their housing ratio that the underwriter would use for qualifying.
Okay.
You calculate?
Loan amount's 200,000?
Yeah, loan amount's 200,000. The income's 60K. The escrow and PMI is $6,000.
83%.
Do we know the interest rate?
It's right here.
Oh, with this?
Yeah.
Okay.
Yeah. So what's the? Sorry.
Oh, so it's 4% interest?
Okay. 20 seconds left.
You said the escrow and PMI was 6,000?
Escrow and PMI is $6,000. What's the housing ratio? The front end ratio that you look at Encompass.
Are you seeing like what payment we're gonna use, or what's the?
What's the qualifying housing ratio? Not the payment, the ratio. What percentage?
What underwriting's on?
Do we need to do all the calculations after that? What's the?
Percentage.
Oh, the percentage of what their payments can be, not what they need to be under to qualify.
Right.
Okay.
For qualifying, yeah. Okay, guys, time's up. What do we got? What do we got for, what's the housing ratio that they're gonna use for qualifying?
27%?
Yeah, how'd you get that?
I don't think it's right. So
I got
200,000 or 6,000 divided by 200, just the PMI into the loan amount. So I took 6,000.
I don't think
I got it right, but I got
I'm calculating
26.
this right.
Yeah, I got 26. but I
You're
don't think I
asking
got it right.
basically
What's gonna be
to
the
calculate what
payment?
their monthly payment is, and then state that as a percentage of their monthly income.
For qualifying, what is the, underwriter gonna use for qualifying them for their housing ratio? What's the percentage?
29%.
How'd you get that?
Well, I just divided the 6K by the 12 months, and then I added that to the payment, which was 954. So it's like 500, 954. I took their 5K a month. Actually, I took the payments divided by the 5K a month, using 29%.
Okay.
Qualifying, you wouldn't use. Would you use just the first?
Well, that's what we're uncovering. So, what'd you get, Brad?
I got 29%.
Okay. What'd you get on?
I got 20, but I didn't factor in the escrow.
Okay. Charles?
I got 27, but I can't remember how I did it.
I got 26.
Looks really good.
Yeah, I had 20%.
Okay.
I didn't factor in escrow.
Okay.
Are we using? So we're not using 4%, right? We would use the first year's adjustment as the interest rate on the
I
loan.
mean, that's what we're trying
That's what we're trying to figure out.
That's what
I
we're.
used
That's
the
what I
4%.
did.
Hmm?
I used the 4.
What rate did you use?
Percent interest
I
rate.
used the 4%.
Yeah, me too.
6. Like what the adjustment would be in the first year.
Fully index rate.
They use the full
Okay,
the
so-
lifetime cap rate.
Yeah, they use it.
So 9% is what they would use?
Yeah.
Okay. Yeah, it makes sense because it would go as high as
Then
the loan amount.
So the ratios
Because
then.
for qualifying,
Yeah,
for under,
that's
for
okay.
qualifying,
Okay, that
okay, yeah.
So we did
And I
that,
was gonna accept
then the escrow is 500 for escrow.
Mhm.
And then how much is the mortgage payment on 200,000 at 9%? 1609. So. So that's the housing ratio the underwriter's gonna look at.
42%. So in this case, if they will qualify, they will be the right fit for,
Well, not for this person, no,
right?
not this
Because
situation.
the income is very low.
Yeah, now we know that the rate is this, but the underwriter's gonna use,
The highest it
Yeah,
can go.
yeah.
Right, got it.
If they had no debts, could they qualify, or what's the?
well, this is the housing. I
This
mean,
is
it's
the front
possible.
ratio.
Do the ratios just run the same as any conventional?
Yeah, the ratios.
They're
are-
just front end though, right?
Yeah, this is
Just front end.
front
So
The front.
Okay.
if they have no other debts, then it's possible.
Possible.
But just based off your question was front end. That's what it
But in the future, there, I'm pretty sure they're gonna have more.
Hmm?
No, never mind.
More income?
Yeah.
Yeah, but they don't go off of that. I mean, they're going off of what their income is now. Their income could also go down. They could also get in a car accident, break their leg, we don't know what that, so.
And I'm guessing if the income does go up, they can always refinance to that at a later time, right?
Yeah, they could refinance depending if it makes sense.
If it makes sense, yeah.
Yeah, but I just wanna make sure that you guys see this because when you got this email with this on here, you know, then you know how to quote it. Now, there's many different ones. There's 3-1 arms, there's 5-1 arms, there's 7-1 arms, there's 10-1 arms. So obviously, the longer that it's fixed for, that can be, you know, now, the 10-1 arm, you know, could have worse pricing than a 5-1 arm. just depends on the person's situation.
I think when you priced it out, did the 10-1 have different than the 7-1?
The 10-1 and the 7-1 were almost the same.
Almost the same, weren't they?
But the 5-1 had a difference.
A little better.
I'd say eighth of a point difference. And then the 3-1 was probably the best.
So how do you find these rates? Where do you?
An optimal blue.
The 7-1 arm, 10-1 arm.
So when you go into loan, the subcategories, you're gonna click, instead of fixed, you're gonna click arm, and they'll give you your 7, 5, 10, whatever options.
Do we offer teaser rates on the bigger one, like the 7-1s or the 10-1s sometimes?
What do you mean teaser?
That's just what we learned in broker class.
It's called
Teaser as far as
But
the
your
bigger-
LTV has to be
Yeah.
at 90%.
At 90%?
Well, hold on, we need to just make sure that this is the introductory rate, that is the teaser rate.
At the 4?
Yeah, because the market's at 4.5.
So if it drops, that's gonna drop as well?
Hmm?
So if the interest rate drops, the fixed rate drops, that's gonna drop as
No,
well?
no, not for the first 7 years, no.
Yeah, for the
Fixed.
first 7 years.
Do we offer all of those, the 2-1, 3-1, 5-1, 7-1?
Yeah, I don't know if we offer a 2,
We focus on like certain ones though.
3,
I
5,
think
7,
7 is
10.
probably the most popular, that's what I go with a lot, so.
7-1?
And that is the 7-1 most popular because on average people stay in their homes like 5 years now?
Yeah, just ask your client, how long do you expect on planning, keeping this house? Is this the end all be all property? Or are you gonna, move out of here? And then depending on their answer, give them the option if they qualify.
Yeah, they qualify.
Yeah, if they qualify. You don't wanna confuse them if you know they're not gonna qualify.
Makes sense.
But for older people with good credit that aren't gonna probably live for that much longer, I've had a couple of those that wanna go with arms just because it makes sense.
Yeah, but I just wanna make sure you guys see how to, see how they work, so that way when it comes up, you can offer this to your customers and, like I said, the knowledge that you have, that you're able to offer more products to them, the higher chance you have to get more loans in.
You can beat a lot of people, but most people don't offer arms, and most people stick with the 30-year fixed rate.
Right, like for me, I would go with an arm, because of the savings,
Yeah.
because think about it, again,
If you're only gonna be in a home for a few years, what reason would there be to not go with an arm?
Fear.
well,
They just don't
It's
understand.
$200 a month,
Understanding the
7
product.
years,
Right.
it's almost $8,500.
yeah.
Is there any prepayment penalty
No.
for this? So they can pay it off in 7 years if
Yeah,
they
they can
want?
sell it.
Yeah, they could sell it, refinance it, but when you're an optimal blue, instead of selecting the fixed one, like you said, just select the arm option.
But for underwriting, it always goes off
The highest,
max
if
rate.
you're good.
That I didn't.
Yeah,
Just in case, I
thought
guess
he
it's
was
being
gonna be
conservative, worst
low.
case scenario.
Right.
Yeah, that makes sense. That makes real sense.
yeah. But yeah, they're really, like I said, for the right customer. Now, what you'll see even more, if rates go higher and higher, then there'll even be a huger spread between the arm and the fixed. So instead of a half a point, you could see a 1 point difference or a 2 point difference if rates keep going higher and higher. So,
That's a bigger teaser rate for
Yeah.
that right here.
Yeah.
Yeah.
Right now, it's almost at a point, full point.
yeah, back
That's a big savings.
a long time ago, there was about a 5 point spread.
Jeez.
Some of the shorter term arms. So,
Thank you.
and FHA offers them too. So when you're pricing them, you can price the FHA one with that as well. When you're pricing optimal blue, maybe you have a guy that's he seems like he's pretty sharp, and everyone else is quoting him at 4.5. Hey, I got a great program for you. I can get you in a 3.75, and it's fixed for 7 years, guys. What about if you offer that to your next big customer, FHA?
Or to win pre-approval people from another lender, so they have less interest rate now.
Yeah.
Give it out.
Hey, no problem. I got something great for you. Let me show you the difference, and I'll show you the breakdown. When you pre-qual your next guy, think about it today when you're looking at your loans. Hey, I got 2 options for you. I can give you the fixed at 4.25, or I can give you this other awesome program that's at 3.5. Oh, okay. This guy knows something.
So what happens after the 7 years? It goes to the market rate?
No, it can go
It can
up
fluctuate.
and down,
Within a range.
depending on the
Yeah,
first
it can
number.
fluctuate by that middle number there, up or down.
After the 7 years?
After the 7 years, it can fluctuate by,
Then it starts-
on this one, 3% up or down, depending on the
The
market.
first year's change, every year after, and then the lifetime change is how you want to divide those numbers.
Yeah, I mean,
It's based on the spread, right? Or it's based on a margin, like it stays a certain percentage above.
I mean, there's the, yeah, I mean, the index is what's the thing that moves. So, the margin is the lender's profit, and you can,
But so your interest rate is the margin above the index, right?
right. Well, I mean, so.
I mean, unless you're capped by the.
Yeah, so let's say that, yeah, I mean, if you'll, let's say that they'll give you 3 different options for different margins, and, each one will have a corresponding cost or credit, and you'll choose, you won't see this all because it's all done on the back end and Opto Blue, you're just gonna choose, you won't ever see any of this, and so, but that's what's happening, like with, secondary market, that's what they're doing. So all you'll see is a yield spread or a call, or you'll see a credit or a cost, and so, you will never see like those things, but that's what's really happening, yeah. But yeah, so the thing is, yeah, with, like, for example, you had your customer that was shopping you with Bank of America or something, I would've whipped this out, you know, and.
I have another.
Huh?
I have a client right now. They want me to give them like a better rate, so I'm just gonna.
Yeah. No, this is not for USDA though. So this is not for USDA.
Correct.
What?
Probably with
No.
USDA low.
No,
No,
they don't offer this on USDA though. Okay. And actually, I think VA offers it too.
Yes, they do.
So you can do a VA.
So it's conventional.
Yeah.
VA, FHA,
VA, FHA.
portfolios.
And, portfolio jumbo, but not USDA. So they haven't caught on it. The farmers are still kind of.
I mean, yes.
Yeah, you can do this on bank statement too.
For a generation.
Huh?
Okay.
Yeah, they're not.
Generational long haul.
Yeah, they're not gonna want
I
it.
have portfolio.
So,
I'm
yeah.
a realtor right now. Yes,
All right.
they don't have
So
money.
pretty
they wanna
good.
get out.
Mario, you can hit stop on that.
Adjustable.
Yeah, thank you, man.
Right.
All right, good training, guys. Awesome. Yeah.